let's start a very first AFM live revision class for the session June 2026. The session is June 2026. Okay. Before I start a very first class, let me just quickly inform you what are the objectives of these live revision classes. A very first objective of these live revision classes is to give you the revision of entire AFM in a very short period of time. Within, I would believe, 12 to 13 hours, you will see, inshallah, that we are going to cover the entire AFM. Second objective, that recent past papers we will be also discussing through these live revision classes. And third objective is how to tackle the pre-scene mock. When the time comes, I'll tell you the strategy of how to go for a ACCA pre-scene mock June 2026, how to get the maximum benefit from that pre-scene mock. I will explain that also during my live revision classes. And I strongly believe each one of you is also having short notes of AFM that covers the entire theoretical part. So whoever does not have the short notes of AFM, then within your relevant WhatsApp group, do message the admin. They will share those short notes with you. And what will be the sequence of live revision classes? The sequence is going to be the same, which we have in our regular classes. We'll start from cost of capital, investment appraisal. So we'll follow the same sequence which we have in our regular classes. Number one. Number two, students, live revision classes are here to support you to actually these classes will give you the opportunity that you can interact with your tutor on a weekly basis. Plus, you will see how we'll be revising the entire course in a short period of time. But you will only be able to get more benefit from these classes if you have already seen lectures, because these are live revision classes. Okay. Plus, mainly you have to follow the study planner. So every one of you must be having a study planner with you also. Whoever does not have the study planner, again, I'm kindly contact admin. They will share the study planner with you. Okay. Some of the students, they just make mistake. They solely focus on live revision classes. So just focusing on live revision classes, that will not help you to pass AFM. Obviously, live revision classes with your regular classes. So the main thing is your first priority is to follow the study planner. So I hope I have made myself very clear. Another thing is, I think maybe after 2 weeks maximum, otherwise after 3 weeks, admin will start sharing the test with you as well. In AFM, we conduct at least 8 to 10 tests, and each test is on, you will get a test on each topic. So you have to be honest with yourself. For example, you have done the entire cost of capital, and let's say you have completed the entire investment appraisal as well. And there's a test which covers both of these topics. So you have to be honest while attempting that test. You have to attempt the test and you have to check that test as well. The question is, sir, how I'm going to check? The answer is, you will be getting a proper video lecture on that test. So once you have attempted that test, after that you have seen the entire lecture on that test, still you have any confusion, so obviously you can always contact, you can always ask question from me, again in your relevant WhatsApp groups. But 80 to 90% of the students, they do not attempt test and they expect that we'll be going to the examination hall and something will happen and they are going to just pass the paper. Things, they don't work like that. You have to follow the entire procedures. If we have built in 8 to 10 tests in your syllabus, it means these tests, they do have significance. They are very important. That is why they are there. They are a part of your syllabus. So we are giving you the opportunity to attempt the test as well. Similarly, near to exam, maximum 15, at least 12 days before the exam, we conduct your proper mock. and that mock will be on a CB platform, which you are going to have in examination hall. You will be facing the same environment. Again, 80 to 90% of the students, they don't attempt mock as well, which is, I would say, they are making mistake. See, when you are attempting the mock 15, let's say at least 12 days before the exam, so you still get, and you will be getting a personalized feedback on that mock, and you will still have at least 12 to 15 days to improve yourself. So kindly try to get the maximum benefit from these opportunities, test, mock, and on mock, you'll be getting a personalized feedback. Even you perform, let's say, not good. If you're not performing up to the mark in your mock, which ASA conducts, no issue at all. You will still have days to, at least 15 to 12 days to improve yourself. So kindly go through all the steps, watch all the lectures. Don't, some of the students, it is also very surprising for me, some of the students, they even skip the lectures also. Don't do that. Either it's a regular class, either it's a practice videos, you're not supposed to skip even a single lecture. Every lecture is extremely important, and please go through all the test, mock, so that at the end of the day you can pass this paper with really good marks. But whoever skips the test, does not go for mock, and skips the videos also, then obviously these things, they create problem. So I think I have clear all the areas how to pass AFM. All you need is follow our instructions. Okay, students, in AFM, before I start the first class, I think you people also have seen, AFM is one of the papers in which, alhamdulillah, we have the honor of producing world top as well. So in this paper, we have produced world top. We have also produced world top in FM also. So let's just start a very first topic, and the name of the topic is cost of capital. Weighted average cost of capital. Okay, now, and let me just, again, I'm repeating, these are the revision classes. So obviously in revision classes, we'll be, obviously the speed will be little bit higher than what you have in our regular classes. Cost of capital. A very first thing which you need to know is cost of, if someone asks you the question, what is cost of capital? Simply cost of capital is cost of financing. Okay. Now the question is, what is the objective of cost of capital? Actually, the objective of cost of capital is investment appraisal. So what is cost of capital? Cost of capital is simply cost of financing, because when I'm going to make investment, for that I need to raise finance, and each source of finance, obviously finance comes with the cost. Nobody is going to give you the finance without the cost. So cost of capital simply means cost of financing, and objective of cost of capital is investment appraisal. Okay, now, if I talk about cost of capital, your company can raise the finance in the form of equity. Your company can also raise the finance in the form of debt. Your company can also raise the finance in the form of preference shares, but which I have not seen in AFM. I've seen that in FM many times. Okay, now, if your company raises the finance in the form of equity, I'm talking about ordinary shares, the cost which your company will have to bear is KE, cost of equity. If your company raises the finance in the form of debt, loan, the cost which your company will have to bear is KD1 minus T. Actually, KD1 minus T means cost of debt after tax. Why we are saying cost of debt after tax here? Because when my company is taking loan, on that loan, I have to pay interest, and interest payment results in tax savings. That is why logically your cost is not only KD, your cost is KD1 minus T. And KD1 minus T actually reduces your cost. Assuming if KD is 10% and the tax rate is 30, so logically my cost is not 10%, my cost is going to be 7%. So what that 1 minus T does, this 1 minus T does not increase your cost. Actually, 1 minus T reduces your cost. What is the logic behind that? The logic is very simple. Interest payment actually results in tax saving. That is why 10% is not actually my cost. My cost is 7%. Now the question is, why we are not having 1 minus t with K? It's very simple. K is cost of equity. For example, I am providing dividend to my shareholders. So dividend is already after tax. That is why there's no need to go. You cannot go now. You cannot do 1 minus t with K, because you are providing dividend to your shareholders, and dividend actually is already after tax. Dividend payment does not save tax. Okay, that is why we do not have 1 minus t with K. Preference shares. If my company raises the finance in the form of preference shares, again, which I have not seen in AFM, then we'll be bearing a cost which is KP, cost of preference shares. And within this KP, cost of preference shares, I will also explain how to calculate the cost of preference shares if your company raises the finance in the form of redeemable preference shares, or your company raises the finance in the form of irredeemable preference shares. There is a possibility your company raises the finance in the form of redeemable preference shares. Obviously, there should be two different methods, two different ways to calculate the cost of preference shares, because redeemable preference shares, they are totally different than irredeemable preference shares. So we will cover both of them. Don't worry at all. Now let's talk about KE, cost of equity. How to calculate KE? One of the method is CAPM. By using capital asset pricing model, we can calculate KE. Another way is dividend valuation model. By using DVM, we can calculate KE. And there's a third possibility as well, which is MM plus tax equation. And this MM plus tax equation, if few attempts back, there was a change in this MM plus tax equation, which is already included in your regular classes. Let us first start from CAPM. And before we start anything else, MM plus tax equation is the alternative of CAPM. So when we'll be revising MM plus tax equation, then I'll explain you where to use MM plus tax equation. Right now, I'm just giving you a very basic concept. If someone asks you what is MM plus tax equation, at least you can reply one single answer, one-liner answer. That one-liner answer is MM plus tax equation is the alternative of CAPM. Obviously, you will study. You will actually revise when we are going to use MM plus tax equation, how we'll be using it. So wait for that. Let's start from CAPM, capital asset pricing model. K is equal to RF plus RM minus RF, and then we have got equity beta. Okay. First of all, K is cost of equity. Another name for the cost of equity is minimum return required by equity holders. And here you need to understand one thing. If something is cost for one party, the same thing is going to be returned for another party. For example, if I'm a company, I'm raising the finance in the form of ordinary shares. So KE is cost for me, cost of equity. But definitely the same thing is written for the shareholders. So KE is cost of equity. Another name for the KE is minimum return required by the shareholders. RF. Now, RF has become very interesting nowadays, especially, even though it is included in my regular classes as well, but nowadays it has become very, very interesting. RF is risk-free rate of return. When we say risk-free rate of return, it means your company has made an investment which does not have any risk. The first question is, sir, can you give us the example of that investment where we are not facing any risk? So actually, it's very difficult to find out that which investment is 100% risk-free. So we do not have any investment where we can say this is 100% with the guarantee it is 100% risk-free. We can't say that. That is why in financial management, we have made a benchmark for the risk-free investment. And there's a rationale behind that benchmark as well. There's a reasoning behind that benchmark, why we made that benchmark, even though that benchmark is very, I would say, shady nowadays. The benchmark for risk-free investment is investment in government bonds. So investment in government bonds is considered as a risk-free investment. But as I mentioned just 1 or maybe 2 minutes ago, nowadays it was questionable earlier as well, but now it is more debatable. The way back, we have seen Sri Lankan government, they defaulted. So the question is, at that time, whoever has made investment in Sri Lankan government bond, then what happened? So what is the, obviously, I already said there's no guarantee. Even you are making investment in government bonds, that is going to be 100% risk-free. There's no guarantee. But in financial management, we have made this benchmark. The benchmark is investment in government bond. Why we have made this benchmark? The reason is very simple. Normally, this is what we believe in financial management. Normally, governments do not collapse. I said normally. I did not say they will never collapse. They do collapse as well. But normally, we say the size of the government is so big, they do not collapse. So simply, investment in government bond is risk-free. But nowadays, I don't think so. Companies, they will be even investing in government bonds. Okay, that is RF. RM, average return on a stock exchange, and nowadays everyone knows that even the stock exchange, so the way stock exchanges are, I would say, falling every day. So I don't know what is happening. So not if you look at this KE, there are a number of limitations in CAPM, and the one limitation is from CAPM, whatever KE we get, it is always a positive return. But nowadays we know that what is happening in this world, logically stock exchange is not giving a positive return to everyone. To the majority of the shareholders, I strongly believe stock exchange is giving them a negative return. And if you don't believe on this, then you should invest in a stock exchange nowadays and just wait for 1 week, maybe 1 or 2 days. Then you will see that how people get negative return from the stock exchange. Nowadays, obviously, stock exchange has given, and they are giving every day negative return to almost every shareholders. But according to CAPM, the return is always positive. But practically now, obviously, we have seen, but I've seen earlier as well, stock exchange sometimes they give negative return also. What is RM? RM is average return on the stock exchange. RM is average return on the stock exchange. Okay. Now, RM minus RF. The difference of RM minus RF is called equity risk premium. There's another name for this, which is market risk premium. And always remember one thing, the higher the equity risk premium or the market risk premium, it means there's more attraction in the stock exchange. Of course, if the equity risk premium is not good enough, then there is no attraction in the stock exchange. For example, if RM average return is assuming 10%, and I'm assuming RF is 9.8%, I don't think so people will go to the stock exchange because just to get a 0.2% additional return, I have to face the risk as well. Logically, the higher the equity risk premium, the higher the market risk premium, it means there's more attraction. You will find more attraction in the stock exchange. Now, the finally is this is equity beta. Now, what is this equity beta? Before we develop any understanding on this equity beta, simply you should have a really good, you need to have developed the understanding on this beta. Actually, beta is a measure of risk. Beta is a measure of risk, and when we say risk, there are two types of risk. One is systematic risk. Another is unsystematic risk. There are two types of risk. One is systematic, another is unsystematic. Now let's listen. Actually, unsystematic risk is a diversifiable risk. This is a risk which you can diversify, spread, you can reduce this risk, even you can eliminate this risk. The name of that risk is unsystematic risk. For example, if company ABC is having $1 million and they want to make investment of $1 million in the stock exchange, if they invest the entire $1 million into, let's say, BYC company, it means your 100% investment is in BYC company's shares, which means that if the share price of BYC company goes up, your 100% investment will go up. If the share price of BYC company goes down, then your 100% investment will go down. It means you did not diversify your portfolio of investment. It means you are playing very risky. Simply, you have put all your eggs in one basket. What if someone takes that basket and run away? Okay, let's leave it. The question is, never do that. You're not supposed to invest the entire amount in one company's shares. So, how to eliminate or how to, in fact, reduce the unsystematic risk? Instead of making the entire 1 million investment which you have in one company's shares, if I take this $1 million divided by 20, I'll get $50,000. $50,000 is 5% of my total investment. So instead of investing in one company, if I make investment in 20 organizations, but in each company I'll be making 5% of, I'll be investing just $50,000, which is 5% of my total investment. Now imagine if you have invested in 20 different organizations, all are different, and let's say they don't have any correlation with each other, they don't have any relationship, industries are different, sectors are different. Now, if one company's share price reduces, then still there will be 95% chances you are going to get the benefit. Even the two companies organization share price reduces, it means you are having a loss in 10% investment, still your 90% of the investment might give you a benefit. So what you have done by doing this, you are having a diversified portfolio of investment, and due to that diversified portfolio of investment, you have reduced your unsystematic risk. Now, according to CAPM, CAPM is having number of assumptions. Out of those number of assumptions, one of them is CAPM assumes that investor is having a well-diversified portfolio of investment. Due to that well-diversified portfolio of investment, unsystematic risk, investor is facing unsystematic risk 0. Now, no matter practically if investor does not have a well-diversified portfolio of investment, even practically investor does not have a well-diversified portfolio of investment, still CAPM assumes the same thing. CAPM works like that investor is having a well-diversified portfolio of investment. That is why unsystematic risk under CAPM is 0. Here you can also get professional skepticism marks when you are, if there's a theory on CAPM and you are writing that CAPM assumes that investor is having a well-diversified portfolio of investment, and due to that unsystematic risk is 0, and you can write that this is debatable. It is not, you can just say that it is not necessary that each investor will have a diversified portfolio of investment. It means the moment you are going to write like this, you are going to write like that, you will be getting a marks for the professional skepticism. But it does not mean that you go to the exam and start challenging everything. Okay, now, so this is all about unsystematic risk. Now let's talk about systematic risk. Systematic risk is not a diversifiable risk. No matter how genius you are, you will be facing this risk, systematic risk. You will face this risk. What are the possible examples of systematic risk? Number one could be rise in the interest rate. Your company is really good, everything is fine. Your company is in XYZ country, and in that country, government increases, central bank increases the interest rate. Now, the rise in the interest rate, if it is going to have bad impact on your business, you can't do anything because you cannot reduce the interest rate. Now the question is, sir, if the interest rate increases, how it can impact my company? They can impact. One, for example, there's an excellent investment opportunity in which you want to make investment. Now cost of financing will be high for you. It will become expensive for you. The project will not be giving you now that benefit which you might be thinking earlier. Another issue, if your if you, if your product is very expensive, okay, let's say your product is very expensive and people, your customers, they need financing to buy your product. What if the interest rate goes high? It becomes then very difficult for your customers to buy your product, because nobody is going to get the loan at a very high interest rate to buy your product. So at the end of the day, your project will suffer. But that is one of the examples of systematic risk. You cannot do anything. Another possible example could be tax rate. If the government increases the tax rate, and it is going to definitely have bad impact on your company, but still you have to face it. You do not have any other choice. Another example of systematic risk, you people, of course, I hope everyone of you is aware of what is happening right now in the world. That is another example of systematic risk. We never thought, even in March attempt, we have never ever thought that in GCC countries, if I'm not wrong, that ACCA papers, they will ever be cancelled. But first time in my life, I've saw that ACCA papers, they got cancelled over there. Systematic risk. We had no idea about this, that this could happen in these countries, but it happened. All those students, they were prepared, they have given fees to the ACCA. Obviously they were also not, obviously they were not thinking like that, but at the end of the day it happened. Paper got cancelled. So systematic risk. So systematic risk you have to face. You have no option at all. Now let's talk about equity beta. Now what is this equity beta? We have discussed beta, measure of risk. We have discussed systematic risk, unsystematic risk. And now let's talk about equity beta. One thing is for sure, whatever is the equity beta is, this equity beta will only represent systematic risk. Why? Because in CAPM, we have already assumed unsystematic risk is zero. Well, now what is equity beta? Actually, equity beta measures the systematic risk of your investment. And this gives you the information. This indicates how your investment will respond to the changes in stock index. Now there's a possibility that we have seen nowadays. There's a possibility that a stock exchange went down by 10%. There's a possibility your investment might went down only 5%. And there's a possibility if the stock exchange went down 10%, your investment could have down by 20%. So equity beta is a measure of systematic risk in your investment, which indicates that how your investment will respond to the changes in stocks index. Now let's talk about positive things. Assuming stock index increases by 4%. If the index increases by 4% and your investment increases by 8%, if investment increases by 4% and your investment but increased by 8%, it means you are getting a return more than the market. If you are earning a return more than the market, we consider your investment is more riskier than the market. Because if something goes wrong in the market, if the stock index reduces, then your investment will reduce by the twice. Because if the rise is 4%, your investment has risen by 8%. So when you are earning more than the market, it means your investment is more riskier than the market. Okay. And those students, they have a really good knowledge of stocks and they might be thinking, sir, stocks and cannot go down by 10% in one day. So kindly, then you should revisit to your knowledge and check what happened in these days. Then you will get to know at some time it is possible that a stock chain might go even below 10%. Okay, that is not our issue. The main thing is if your investment is giving you the return more than the market, we consider your investment is more riskier than the market. Now, for example, let me just quickly write one data and I want every one of you to give me the answers. The main thing is not answers, the main thing is going to be the interpretation, which I want every one of you to understand nicely. Beta equity 0. Second, let's say equity beta is 0.8. Third, let's take beta equity 1. And the fourth, equity beta, make it 1.5. So kindly give me the answers. Number one, students, equity beta 0. If your equity beta is 0, it means your investment is not facing any risk. The question is, if my investment is not facing any risk, so what kind of investment is this? It means your investment is risk-free investment. When my investment is risk-free, then I should demand the return equal to RF. Why KE comes equal to RF when the equity beta is 0? Mathematically, it comes KE is equal to RF, but I'm giving you the logic. The logic is equity beta 0 means your investment is not facing any systematic risk. If my investment is not facing any risk, so what kind of investment is this? I have answered. It means you have made a risk-free investment. When I've made a risk-free investment, then my return, I'll be demanding a return which is going to be equal to RF. And you can see that mathematically also. RF plus RM minus RF. Obviously, equity beta is 0. That 0 will make entire bracket 0. So your answer is going to be K is equal to RF. Second, students, if your equity beta is less than 1, when your equity beta is less than 1, the interpretation is your investment is less riskier than the market. When your investment is less riskier than the market, here the market is stock exchange, okay? When your investment is less riskier than the market, when your investment is less riskier than the market, then you are going to demand return lower than the market. And in this case, you will have KE lower than RM. In this case, you will have KE lower than RM. So what is the interpretation of beta equity less than 1? The interpretation of beta equity less than 1 is your investment is less riskier than the market. When my investment is less riskier than the market, then obviously I will demand the return lower than the market. So logically, K is going to be less than RM. Let's see mathematically also. K is equal to RF. RF is 8%. RM is 15 minus 8 and 0.8. And students, according to the examination report, on average, I'm saying on average, almost every student means every, which AFM report says, examiners report, on average, 7 to 8 marks on average every student loses. You know where every student loses around 7 to 8 marks? In their mathematics, in their plus minus multiplication. Even though now we solve each and everything on the spreadsheet, so kindly do not make any arithmetic errors. 7 to 8 marks means a lot. So sometimes a little negligence on this plus minus can cause you 7 to 8 marks, losing 7 to 8 marks. So everything is very important. 15 minus 8, I'm getting 7, then into 0.8. Entire answer is 5.6 plus 8. K, I'm getting 13.6%. And you can see that this 13.6 is lower than RM. Logically, you are correct. And mathematically also. Don't worry at all. Third, equity beta is equal to 1. Now, student, listen. Equity beta is equal to 1 is considered as a benchmark beta. Repeat. Equity beta is equal to 1 is considered as a benchmark beta. Now, what do you mean by benchmark beta? Benchmark beta means the systematic risk of your investment is equal to the systematic risk of the market. Again, I'm talking about the stock exchange. Number one question is why I'm saying systematic risk. If you just recall one point which I said many times, in capital asset pricing model, there are number of assumptions. Out of them, one is investor is having a well diversified portfolio of investment. So when investor is having a well diversified portfolio of investment, that is why CAPM says unsystematic risk is 0. So we are left with only systematic risk. That is why I mentioned in my explanation systematic risk. Now listen the interpretation again. Equity beta is equal to 1 means it's a benchmark beta, which means that systematic risk of your investment is equal to the systematic risk of market. Now your investment is facing exactly the same risk which market is facing. In that case, you should demand the return equal to what market is providing the average return. So KE is going to be equal to RM. If you look at the mathematically also, KE is equal to RF is 8%, 15 minus 8 into 1. So logically, it's going to be 8 plus 7, I'll get 15%. Or whoever loves maths, you can do this also. RF plus RM minus RF into 1. So logically, it will be like this. RF cancel, KE will be equal to RM. Finally, if your equity beta is more than 1, students, when equity beta is more than 1, sir, it does not look like 1. Okay, let me make it 1, no issue at all. I hope it is near to 1. If your equity beta is more than 1, it is your investment is considered more riskier than the market. When my investment is more riskier than the market, I will demand return more than the market. Simply, higher risk, I'll demand higher return. Will I get that return? That's a different, I would say, story altogether. But at least when I'm facing a higher risk, I'm going to demand higher return. That's very simple. Is there a guarantee I'm going to get that return? There's no guarantee. So we are just giving you a basic concept. You're facing higher risk, you are going to demand a higher return. So simply equity beta is more than 1, it means your investment is more riskier than the market. When investment is more riskier than the market, I am going to demand a return more than the market. So K is equal to RF in our question is 8%. RM is 15 minus 8 and equity beta in the fourth case is 1.5. Okay. 15 minus 8 gives me 7. Multiplied by 1.5 gives me 10.5. The answer of this is 10.5 plus 8. I'm getting 18.5. So you can see that K is more than 15%. So why it is coming more than RM? Because equity beta is more than 1. When your equity beta is more than 1, it means your investment is more riskier than the market. When your investment is more riskier than the market, you will be demanding a return more than the market. And I'm just putting emphasis only on one thing. You are demanding this return. Will you be getting this return? There's no guarantee. There's no guarantee. Okay. Now I want to say one thing. Student, listen. If you come back to the question, Look at this, beta equity 0 means you have made investment which is risk free. By looking at 0.8 equity beta, we can say one thing, my investment is less riskier than the market. By looking at equity beta 1, I can say one thing, my investment and market risk is equal. By looking at 1.5, I can say one thing, my investment is more riskier than the market. Which means that if someone asks you the interpretation of KE by using CAPM, we know that what is KE, cost of equity, another interpretation is minimum return required by equity holder. But someone is asking you a question, the KE which you are getting from capital asset pricing model, what is the, I would say, logical, technical interpretation of that KE? The interpretation is KE from CAPM actually relates to the systematic risk of investment. In mathematical words, it actually relates, it actually depends on equity beta. Now look at this. By looking at beta equity is equal to 0, we can say one thing, K is equal to, K will be equal to RF. Beta equity is 0.8, we can say one thing, K is going to be lower than RM. How much lower is not a concept. The concept is going to be lower than RM. By looking at 1, I can say K will be equal to RM. By looking at 1.5, I can say that K is going to be more than RM. So logically, if someone asks you a question, what is the interpretation of K from CAPM? The answer is K from CAPM relates to the systematic risk of investment. Okay. Now let's go ahead. There's one more way of calculating K, and that is dividend valuation model, or you can say dividend growth model. Let me first write the formula. K is equal to D naught 1 plus G upon P naught plus G. Of course, KE, we know that K is cost of equity. Another interpretation is minimum return required by equity holder. D naught is current dividend per share. D naught is current dividend per share. G is annual dividend growth rate. G is annual dividend growth rate. P naught is current share price, but X div means excluding dividend. P naught is current share price, but X div means excluding dividend. Nothing is mentioned. Whatever current share price your examiner gives you, that is treated as X div. There's one more price which is cum div, cumulative of dividend. We do not use cum div in our DVM formula. Cum div means the price which includes the impact of dividend. Whenever examiner gives you the cum div price, it will be categorically clearly mentioned in the question that given price is the cum div price. Otherwise, as I just told you, nothing is mentioned. We will always assume given current share price is X dividend. For cum dividend, examiner will have to mention cum dividend. Okay, now there's one very important question. And listen that question kindly, nicely. The question is, sir, why? We are not using cum div price. Why we are using X div price? One explanation is very simple. This is the formula. In this formula, we can't do that. Okay, blah, blah, blah. But what is the logic behind that? Now listen to me carefully. What is the logic? Listen. Cum div price means share price with the dividend. Means your company has just announced the dividend and share price is having the impact of that dividend. Cum div price exists at the stock exchange, but only for few days. Let's say 45 days. Within 45 days, obviously shareholders, they will take their dividend. So throughout the year, cum div price does not exist throughout the year in the market. It exists only for few days. But when I say X div, excluding dividend, normally throughout the year share prices, which you will see at the stock exchange, they will be X dividend, excluding dividend. But the question again remains same. Why we are using X diff prices? Why we are not using cum diff? Now listen the reasoning nicely. I said cum diff price exists only for few days. Throughout the year, the price will exist. That will be X diff. Now listen. What is the objective of cost of capital? Student, listen. The objective of cost of capital is investment appraisal. Where actually I'm going to use this cost of capital? I'm going to use this cost of capital in investment appraisal. And investment appraisal is a long-term decision. It is not a short-term decision. Investment appraisal is a long-term decision. It's not a short-term decision. So why we are not taking cum diff prices? Because I'm not going to utilize this KE in a short-term decision. I'm going to utilize this in a long-term decisions. That is why I'm not taking this cum diff values. I'm taking X diff values. So logically, if you come across any decision-making situation where you have to make a decision in a very short term, then you should be using a cum diff price. Just for the sake of your knowledge, I'm giving you the example where actually we use cum diff price. In UK, if someone is dead, assuming Mr. Y is dead, and I need to calculate death estate of Mr. Y, and assuming Mr. Y has left some of the shares in his estate as well, then why valuing those shares? According to HMRC, which is UK taxation authorities, I have to value those shares by using cum diff price. Even that company has not declared the dividend, still the HMRC says just you do one thing, the next dividend which you expect that Mr. Y would be getting if he was alive, just consider the next dividend. So you should value those shares by using cum diff price. So I'm just calculating the death estate. So according to HMRC, if you are calculating the value of a deceased person and that person is having shares in his estate, then you have to value those shares at cum diff price. Now due to cum diff, what happens? Death estate will increase. Obviously, when death estate will increase, UK taxation authorities, they will be getting a higher tax. But that is not our issue. Right now, basically, we are concerned with dividend valuation model. In dividend valuation model, we use X diff values because I'm going to utilize cost of capital in investment appraisal, and investment appraisal is not a short-term decision. It's a long-term decision. That is why we use X diff values. One more thing. D naught 1 plus G. Student, G is the annual dividend growth rate. In dividend valuation model, we assume that annual dividend growth rate is constant. D naught is current dividend. Now try to understand. D naught is current dividend per share. If I multiply this current dividend with 1 plus growth rate, then I'll be getting D1. Now what is D1? D1 is next year expected dividend. Look at the interpretation. I'm just not writing next year dividend. I'm saying next year expected. Of course, again, there is no guarantee. So this is next year expected dividend. If I put more maths little bit, if it is D24, 1 plus G logically will give me D25. So D1 is next year expected dividend. One more thing, student. Look at this formula, please. If you are using dividend valuation model to calculate KE, then mathematically your KE must be greater than annual dividend growth rate. Look at this plus. Whatever is the answer of this fraction, within that answer you will be adding this G. So logically, by using this formula, your KE has to be higher than growth rate. If by using DVM, you are getting KE lower than the annual dividend growth rate, so obviously then you are making a really big mistake. As I mentioned, the report says on average every student loses 7 to 8 marks in their by making these small errors. So never make these kind of errors. So KE will have to be more than annual dividend growth rate. Now there's one more question I just want to give answer, and we'll be then ending today's class because it's a first lab revision class, and I don't want first lab revision class to be very long. But after that, you will see inshallah from the next class onwards. They will remain 1. but the duration will definitely increase. Okay. Now, some of the students, they think like that, sir, by using CAPM, we can calculate KE. By using DVM, we can calculate KE. So the question is, when I'm going to utilize CAPM, when I'm going to utilize DVM? The answer is very simple, students. Data of the question will guide you. Data of the question. If you are solving a question of cost of capital and in the entire question there's no equity beta, there's no RF, there's no RM, it means there's no information of CAPM. But all the information of dividend valuation model is given. So obviously I'll go for a dividend valuation model formula. If I do not have any information of dividend valuation model, but I have all the information of CAPM, so I'll go for CAPM. I've never seen in AFM, but for your knowledge, I'm just telling you, what if you come across a question which gives you the entire information of CAPM as well as DVM? Now the question is, which one should I use and how? Look at the answer. If you come across a question where the information is so much that you can easily apply where CAPM is easily applicable as well as DVM is also applicable, from both you will be getting different KEs. You are not going to get the same KE. So what are you going to do? First, you will be calculating the KE from CAPM. Then you will also calculate the KE by using dividend valuation model. But after that, you have to write one single line. And that single line will be that KE from CAPM is preferable over KE from DVM due to limitations of DVM. That's it. No need to give the limitation. There's no need to write the limitations on DVM. If you come across, again I'm repeating, if you come across a question in AFM, which at least I have not seen, the way back there was a question, but the recent attempts I have not seen, that there's enough data you can calculate KE from CAPM as well as DVM. So first you should calculate KE by using CAPM. You should also calculate KE by using DVM. After that you have to write a single line, and that line would be that KE from CAPM is preferable over KE from DVM due to DVM limitations. So students, that is all about first live revision class. As I mentioned, from the next class, duration of the live revision class will definitely increase. So that is all about today's class. Again, kindly follow your study planner strictly. Your study planner is the main thing. You have to follow the study planner strictly. Second, wherever you get stuck in any of the, I would say, regular class, you can always ask the question in your relevant WhatsApp group. Even you can send me the message privately, no issue at all. I will try my best to reply within 3 to 5 minutes. So that is all about today's class. Is there anything, students, any one of you want to ask before I end today's class? And kindly do give the feedback on today's class in your relevant WhatsApp groups. Thank you.